Making sense of complex financial reports, especially from these massive companies in healthcare, it can often feel like you're trying to decode some kind of secret language.
Oh, absolutely. It's dense stuff.
But when you crack that code, when you really get what's inside, it can give you a real edge, right, in understanding the big trends shaping whole industries.
That's the key, yeah. Seeing the bigger picture.
So today we're doing just that. We're taking a deep dive into the latest Q2 2025 earnings report and the earnings call from Elevance Health.
A major player, obviously.
Exactly. And this isn't just about, a pile of numbers. It's about trying to understand the current pulse of the healthcare landscape through their eyes.
What are they seeing? What are they dealing with?
Right. So our mission here is to pull out the most important bits of knowledge, the insights from all this material. We'll look at the headline figures, sure, but maybe more importantly, we'll unpack why certain things are shifting.
The story behind the numbers.
Yeah, the key challenges Elevance is facing and how they're, strategically trying to respond to everything changing around them. Get ready for maybe some surprising facts and hopefully a clearer picture of what's really going on in health benefits.
Sounds good. Let's jump in.
All right, let's kick things off with those headline numbers. Elevance Health's second quarter of 2025, their operating revenue hit $49.4 billion.
Wow. That's a big number.
It really is a solid 14.3% increase compared to Q2 last year. And diluted EPS for the quarter was $7.72 or $8.84 on an adjusted basis. So you look at that, it sounds pretty strong, right? Blockbuster quarter.
It does on the surface. But
Yeah.
what's really fascinating here, I think, is the forward-looking part. Because while those top-line numbers, yeah, they're robust, Elevance actually revised its full year 2025 adjusted EPS guidance down.
Okay. Down to what?
Down to approximately $30 per share. And that's a pretty significant adjustment.
Yeah, it is. So what's driving that pullback?
Well, it really reflects these sector-wide pressures we're hearing about, particularly elevated medical cost trends, things costing more. It's hitting the whole industry.
Right. So it's a signal that even with good revenue, the underlying costs are creating some headwinds.
Exactly. That's the tension right there.
Okay. So if revenue looks good, but the outlook is cautious, what does this all mean? The company's leadership, they pointed to two main things, didn't they?
They did. Elevated medical costs in their ACA plans, the Affordable Care Act plans, and then slower than expected rate alignment in their Medicaid business.
Okay, let's dig into those because that seems crucial for understanding the wider healthcare picture. Let's start with the ACA market. What's happening there?
So in the ACA market, Elevance said they observed a market-wide increase in morbidity and acuity.
Okay, break that down. Morbidity and acuity.
Right. So morbidity is basically the prevalence of disease, how common sickness is. Acuity is the severity of the illness. So they're seeing sicker patients, essentially, with more complex, more expensive conditions.
And why is that happening now?
A big driver, they say, is membership shifts from Medicaid. With the whole redetermination process unwinding, people losing Medicaid coverage.
Right, the unwind.
Some of those folks are migrating onto the ACA exchanges. And it seems the ones moving might be, on average, less healthy than the previous ACA population.
Huh. So Medicaid redeterminations are actually reshaping the commercial market's risk pool.
It looks like it. It's pushing these higher-cost members into ACA plans, maybe more than insurers fully anticipated. They also mentioned lower effectuation rates.
Effectuation, meaning?
Basically, fewer people who picked a plan actually followed through and paid that first premium to make it active. So maybe some healthier people signed up but didn't finalize. It adds to the imbalance.
Gotcha. And how much of the financial hit does Elevance think comes from this changing mix of members?
They put a number on it. About 70% of the financial impact they're seeing is down to this changing risk pool.
70%. Okay, so that's the biggest piece. But it's not just who is enrolling, right? It's also how they're using care.
Exactly.
Yeah.
That's the other part of the equation. Beyond just the member mix, they're seeing higher utilization. People are using more services.
Like what kind of services?
Across several categories, actually. Emergency room visits are up. Behavioral health services, that's a big one. And certain prescription drugs, especially the really expensive specialty pharmacy ones.
So a broad increase in usage. That sounds expensive.
It is. And then they highlight another issue, which sounds, well, frankly, pretty concerning. Specific providers.
What about providers?
They said some are using more aggressive coding tactics and inappropriately leveraging the independent dispute resolution process, the IDR process, from the No Surprises Act.
Wait, the No Surprises Act, wasn't that supposed to help patients with bills?
That was the idea, yeah. protect patients from surprise out-of-network bills. But it seems some providers are using this arbitration process, the IDR, to push for extremely high payments.
How high are we talking?
Like this. Elevance shared a detail that they've seen payment requests sometimes as much as 21 times the original billed charges.
21
Yeah.
times. That's unbelievable. How much does that contribute to the cost problem?
They estimate that specific issue contributes about 30% to the total cost overruns they're seeing in ACA.
Wow, 30% just from that. What does that say about the No Surprises Act itself? Is it flawed?
Well, it definitely highlights a potential loophole or an area prone to aggressive tactics. The intent was good, but this kind of behavior suggests a real challenge to, payment integrity.
Are they fighting back on that?
They are.
Yeah.
Elevance actually filed a lawsuit over what they see as misuse of the IDR process. So they're taking it seriously, treating it like a systemic issue, needing legal clarity, not just an internal tweak.
Okay. And they were clear this isn't just their problem, right? This higher acuity, sicker patients. It's market-wide.
Yes, they emphasize that. It's a broad trend, not specific to their pricing or risk adjustment failing. Now, for the rest of 2025, they're assuming ACA membership stays pretty stable.
Okay.
But they do expect a, quote, meaningful Q4 surge in utilization.
Why Q4?
It's pretty common. People trying to get elective procedures done before the year ends, maybe before deductibles reset, or in this case, possibly before potential changes to subsidies kick in.
Ah, the year-end rush. Got it. Okay, let's switch gears then. The other big pressure point was Medicaid. What's the story there? You said costs moderated, but not as much as expected.
Right. The slowdown in cost growth was less pronounced than they'd hoped for in Q2. And if you connect it to the bigger picture, it's kind of similar to ACA in some ways.
How so?
They're seeing higher acuity in Medicaid, too. Again, linked to the redeterminations as states check eligibility, relatively healthier members might be more likely to disenroll or find other coverage.
Leaving behind a pool of members with higher needs.
Exactly. A sicker, higher-cost population remaining in the program. Plus, there's just an overall increase in how much members are using services.
And the rates the states pay Elevance for managing these members? They aren't keeping up.
That seems to be the crux of it. Their rate updates for the members reviewed in July. They match what Elevance initially assumed, but those assumptions were based on older data. The rates lagged behind the current higher cost levels.
So the payments are based on yesterday's costs, but they're paying today's bills.
Kinda, yeah. So now they expect a longer slog to get Medicaid margins back where they want them, because it just takes time for states to see the new cost data and build it into future payment rates. It's a lag effect.
It's like trying to steer a ship with a delayed rudder response.
That's a good way to put it. And they gave a fascinating breakdown for 2025 Medicaid cost drivers.
Oh, yeah. What did they say?
About 1/3 of the cost trend is driven by this higher acuity, the sicker members. But 2/3 is now driven by utilization and coding.
2/3 utilization and coding. That's different from last year, right?
It is a notable shift.
Yeah.
In 2024, acuity was the bigger driver. Now it's more about how patients are using services and perhaps how those services are being coded and billed. That's having the larger impact.
Yes.
Subtle, but significant.
Definitely. Okay, so ACA and Medicaid, clearly facing some pretty serious pressures. But it can't be all bad news, right? You mentioned Elevance is a diversified company. Where are the bright spots?
Oh, absolutely. And this is important. Their Carelon platform, that's their health services division, includes pharmacy benefits and other services. That's a real growth engine.
How's Carelon doing?
It's doing incredibly well. Carelon's operating revenue soared 36% in Q2 compared to last year. 36%.
Wow. Okay, what's driving that?
It's broad-based within Carelon. Carelon Arcs, which is their pharmacy benefit manager, saw revenue grow over 20%. They're gaining traction with bigger clients, scaling up their specialty pharmacy stuff.
And the services side.
Carelon Services even more impressive. Growth over 50% in both revenue and operating gain.
50%. Oh.
A lot of that comes from recent acquisitions they made in areas like home health and pharmacy services. Plus, the rapid scaling of something called CareBridge.
CareBridge.
Yeah, it seems to focus on managing care for complex populations, like dual eligibles, people on both Medicare and Medicaid, and those high acuity Medicaid members we talked about. So their strategy of building out these service capabilities is really paying off.
So diversification is working in that sense. What about Medicare Advantage? That segment's always in the news. Any issues there?
Actually, no, not according to them. They said Medicare Advantage cost trends remained in line with their expectations. They're still targeting stable margins for the year there.
So MA is holding steady for them. What about looking ahead to 2026 bids?
Their word was disciplined. They're prioritizing plan offerings that keep members happy and are sustainable long-term, focusing specifically on HMOs and those dual-eligible plans.
So not chasing growth at any cost in MA sounds like being cautious.
Seems that way. They even mentioned their employer group business. The traditional job-based insurance, excluding the ACA part, they're pleased with margin recovery there too. They see the market hardening.
Hardening, meaning less competition, better pricing.
Sure. Essentially, yeah.
Yeah.
More rational pricing for those fully insured products. So while Carolyn is humming along nicely and MA and employer groups look okay, it really does seem like ACA and Medicaid are the main headaches right now.
Okay, so we've laid out the challenges, ACA costs, Medicaid rates, and the bright spots like Carelon. Now, the big question, what are they actually doing about the problem areas? How are they trying to manage this dynamic environment?
Right. They're focused on strengthening what they call structural performance. Fancy term, but
Well,
basically.
just trying to fix the underlying issues.
Exactly. Intensifying efforts to stabilize costs in those really expensive areas like specialty services, post-acute care, care after a hospital stay. They're also talking proactively with their state partners about getting those Medicaid rates caught up.
And for ACA.
They've already repriced their ACA products for 2026, factoring in this higher cost intensity they're seeing now, trying to get ahead of it for next year. It's about being nimble, adjusting pricing as the landscape shifts. Makes sense. You also mentioned acquisitions earlier. Are they leaning on technology too? Seems like everyone is these days.
Oh, heavily. Technology is a huge part of their strategy here. They talked about significantly streamlining prior authorization processes.
Prior auth. Everyone loves that topic.
Right. But they say over half of their electronic requests are now processed in real time, which, is a big deal for speeding things up for doctors and patients.
Real-time approvals. That's actually pretty impressive. What else on the tech front?
They're using AI-enabled tools, things called Health OS and Intelligent Clinical Assist. The idea is to streamline clinical workflows, maybe speed up routine approvals by quickly surfacing the relevant patient data for review, using data smarter, faster.
So AI isn't just a buzzword. They're actually deploying it for these core processes.
Seems like it, both for efficiency and potentially for things like payment integrity, spotting those aggressive coding issues we discussed earlier.
Okay, so better processes, tech investment. Are they also changing how care is delivered or paid for?
Yes, absolutely. They're expanding their value-based care portfolio, especially in areas like behavioral health and oncology.
Value-based care, meaning paying for outcomes, not just procedures.
That's the goal. They said over 1/3 of their total benefit expense is now in what they call downside risk arrangements.
Downside risk. So the providers share the financial risk if costs go too high.
Exactly. It incentivizes providers to coordinate care better, be more efficient, focus on keeping people healthy because they have skin in the game financially. It shifts focus from just volume to actual value and cost predictability.
Interesting. 1/3 is a pretty significant chunk under that model. What about money capital allocation? Did they talk about stock buybacks or M&A?
They did. They mentioned they were a bit flexible, maybe held back slightly on share repurchases in Q2, given how dynamic things were.
Understandable with the guidance change.
Right, but they plan to be more opportunistic buying back stock if they think it's trading below its intrinsic value. Their long-term strategy remains pretty consistent, though, which is roughly a 50-50 split. Half the capital goes to M&A, like those Carelon deals, or organic reinvestment in the business. The other half goes back to shareholders, about 30% through share repurchases and 20% via dividends.
Okay, so the underlying strategy hasn't changed, just maybe the short-term tactics. Did they mention any looming policy changes? Anything else on the horizon?
Yes, one significant thing. The recently passed budget reconciliation bill, specifically potential impacts from Medicaid work requirements and more frequent eligibility reviews in some states.
More potential disruption for Medicaid enrollment and costs?
Could be. It could create near-term enrollment pressures, maybe further shifts in the risk pool if certain groups are affected differently. It adds another layer of complexity to that Medicaid business.
How are they preparing for that?
They noted they have operated in states with work requirements before, so it's not entirely new territory. And they emphasize their strong partnerships with states to navigate these kinds of changes. But it's definitely a reminder, isn't it, how much policy shifts can directly impact these companies' bottom lines.
Absolutely. Okay, so let's try and wrap this up. As we pull back from this really detailed look at Elevance Health's Q2, It paints a picture, doesn't it? A company navigating some pretty serious headwinds.
Definitely, particularly in those ACA and Medicaid markets. Shifting member sickness levels, higher utilization, big challenges.
But at the same time, it also shows a strategic player. They're leveraging those diversified parts of the business, like Carelon, which is booming. They're investing in tech, being disciplined on pricing where they can, trying to stabilize things.
Yeah, and if you connect this to the bigger picture, it just underscores how tangled up healthcare finance is with everything else.
Yeah.
Government policy, market dynamics, even how individual doctors and hospitals behave, like with that coding issue.
It's incredibly complex.
It really is.
Yeah.
And the challenges Elevance is tackling, managing these complex risk pools, dealing with policy changes, trying to use AI for efficiency and to catch problematic billing. These are really indicative of the trends shaping the entire healthcare system right now. Everyone's grappling with this stuff.
It shows the constant need for adaptation in this industry.
Constant adaptation, exactly. Which I guess raises an important question for you listening to this.
Well,
As these big healthcare companies like Elevance adapt to these really unprecedented shifts in costs and regulations, all this focus on disciplined pricing and stabilizing trends and reinforcing the operational foundation, what does that ultimately mean?
what does it mean for the end user?
Yeah. How might that reshape the availability, the affordability, maybe even the type of health benefits available to you and your community in the next few years?
Yeah.
It's definitely something to mull over.
A complex puzzle with very real-world consequences. Definitely food for thought.